If you want to understand real estate in 2025, don't start with interest rates, inventory numbers, or government policy. Start with this. A bidding war broke out recently, not over a luxury home, not over a downtown condo, but over a garage. Not a garage attached to a house. A standalone one-car garage behind a row of houses in a mid-sized U.S. city. It listed at $49,000 and attracted 32 offers, most in cash, ultimately selling for more than double its asking price. Why? Because investors weren't buying a place to park a Toyota. They were buying the belief that anything tied to land, even a glorified storage shed, is still worth fighting for in an era where real estate feels like a mix of stability, FOMO, and financial roulette. That bizarre little story captures the moment we're in. The 2025 housing market isn't behaving like a calm, predictable investment landscape. It's behaving like a pressure cooker. Buyers are anxious, sellers are strategic, investors are nervous but active, and analysts still can't agree on whether a crash is overdue or if homes will keep rising indefinitely. So the big question hanging over every would-be homeowner, investor, or casual Zillow window shopper is simple. Are houses in 2025 still a safe bet, or are they becoming a risky gamble? To answer that, we need to strip away the hype, the fear, the clickbait predictions, and the overly optimistic forecasts. What matters isn't just whether prices go up or down, it's whether the underlying forces shaping this market are stable or fragile. And as of 2025, real estate sits right at the intersection of two competing realities. One, where housing remains the most time-tested store of value in modern history, and another where affordability metrics, macro trends, and structural constraints are flashing warnings like hazard lights on a dashboard. Let's start by looking at what's actually driving today's environment, not the surface-level headlines, but the deeper mechanics. Because the truth is, the 2025 market wasn't formed overnight. It's the product of a decade-long chain reaction. Cheap money, demographic shifts, underbuilding, government stimulus, investor activity, and a cultural shift where homeownership isn't just a financial decision. It's a social identity, a status signal, and for many, a survival strategy against inflation. One of the biggest forces shaping the current landscape is the hangover effect from the past few years of rate volatility. Throughout the early 2020s, rates went from historic lows to multi-decade highs, shocking buyers and sellers alike. That whiplash created a market where millions of homeowners are locked into ultra-low mortgages. They're not selling unless they absolutely have to. Imagine holding a 30-year mortgage at 2.8%. Selling your house isn't just giving up a home, it's giving up a financial advantage that may never return. That decision alone has removed enormous numbers of homes from the market, reducing supply even as population and demand continue to rise. This supply constraint has created an unusual dynamic. Even when demand drops, prices don't fall much because there simply isn't enough inventory to create downward pressure. Think of it like a store that refuses to restock shelves but still attracts customers. Even if fewer people walk in, the scarcity keeps prices high. That's why 2025 homebuyers are still encountering competition in markets where economic conditions suggest there shouldn't be any. But this low supply environment leads to a deeper question. If homes are so hard to find and prices remain elevated, does that automatically make real estate a safe investment? Not necessarily. High prices supported by scarcity are very different than high prices supported by fundamentals like income growth. And in 2025, the gap between home prices and incomes is wider than ever. In many cities, the average household would need decades, literally decades, to save for a typical down payment. That disconnect raises the risk that, even if prices don't crash, they may stagnate or grow at a slower pace because people simply can't afford to keep bidding them higher. And affordability isn't the only red flag. Something interesting is happening with buyer psychology. More people are starting to view real estate through a lens of skepticism, questioning assumptions that previous generations took for granted. Homeownership used to be the predictable, unquestioned path to wealth. Now it's a math problem, a debate topic, and in some cases, a calculated risk. The fear of being priced out forever coexists with the fear of buying at the peak. People are torn between action and hesitation. That emotional volatility feeds uncertainty, and uncertainty feeds market unpredictability. Now layer on top of that a shift in investor behavior. For years, institutional investors were aggressively buying single-family homes, reshaping neighborhoods and absorbing inventory. But in 2025, their approach is noticeably more cautious. They haven't disappeared, they're just being more selective. They're running tighter models, avoiding speculative markets, and focusing on cash flow opportunities instead of pure appreciation plays. That shift alone signals that even the most data-driven players see a mix of opportunity and risk. But the question remains, is real estate still a safe bet? To answer that, we have to redefine what safe even means. Safe for whom? Safe under what conditions? Safe compared to what? A home can be a stable wealth-building tool for someone planning to stay put for 10 years, while simultaneously being a risky gamble for someone stretching their finances hoping for rapid appreciation. In 2025, safety in real estate depends more on personal time horizon, financial cushion, and local market conditions than on national trends. And this brings us to a truth that often gets overlooked. Real estate is becoming increasingly local again. National charts can tell you the general direction of the market, but they can't capture the microclimates forming across the country. Some regions are booming, fueled by population inflows, job growth, or limited land availability. Others are cooling as people move away, remote work declines, or climate risks become more apparent. A house in a high-growth city might still be one of the safest investments of the decade, while a house in a shrinking region could behave more like a depreciating asset. The divergence between markets is widening, and that alone makes the old rule, real estate always goes up, far less universal than it used to be. But let's stay with fundamentals for a moment because they matter. When people ask whether real estate is a safe bet, what they're really asking is whether forces like supply, demand, demographics, and economic stability are aligned in favor of long-term price resilience. And on a broad level, the US still has strong demographic demand. Millions of millennials and Gen Z adults are entering prime home buying years. Housing construction remains below what the population needs. Immigration continues to contribute to demand. Land in desirable areas is limited. Those factors aren't temporary, they're structural.
At the same time, risks are also structural. Affordability pressures, labor shortages in construction, climate-related insurance issues, and unpredictable policy shifts all introduce new layers of risk that didn't exist or didn't matter as much 10 or 20 years ago. And while no one can predict the exact future of home prices, we can analyze how these competing forces interact. What we're seeing is a market held up by fundamentals, restricted by supply, supported by demand, yet constrained by affordability and vulnerable to economic shocks. In other words, it's not a bubble in the classic sense, but it's also not a carefree landscape where buying anything, anywhere, guarantees profit. The illusion that real estate is a risk-free bet has cracked. Not shattered, but cracked. People can feel it. And that's why the conversation around housing in 2025 feels different from any previous year. There's more nuance, more caution, more awareness that real estate isn't just a path to wealth. It's a complex, interconnected system shaped by forces outside any individual's control. And the more you analyze those forces, the clearer it becomes that real estate's long-term strength comes from its real-world utility. People will always need shelter. Land will always be finite. Homes will always have intrinsic value. That's why, even in moments of uncertainty, real estate doesn't behave like speculative assets. It moves slower, it corrects less violently, it holds value better because it's rooted in physical reality. But that doesn't mean prices can't fall or stagnate. It just means that the downside tends to be stickier and the upside tends to be steadier, which is why so many investors still view housing as a cornerstone asset. But here's the irony. The very thing that makes real estate resilient, its slow, steady nature, is clashing with the fast-paced expectations of a generation raised on digital investments, rapid returns, and instant financial gratification. Housing is long-term by design, but many buyers are evaluating it with short-term lenses. That mismatch creates frustration, impatience, and in some cases, mistakes. People want certainty in a market that refuses to provide any. Still, despite the volatility, despite the affordability challenges, despite the mixed signals, real estate remains one of the few assets that serve both financial and personal needs. It's not just an investment, it's shelter, stability, identity, and for many families, a foundation for generational wealth. That dual role gives it a layer of durability that stocks, crypto, or bonds can't replicate. So, as we move deeper into 2025, the real question isn't whether real estate is safe or risky. It's how to approach it in a way that minimizes risk and maximizes long-term benefit. Because the truth is, The market isn't going to suddenly become cheaper, simpler, or more predictable, but understanding the forces driving it, the risks shaping it, and the opportunities hidden within it can make the difference between buying smart and buying blindly. And right now, the landscape is full of contradictions. High prices, but limited supply. Strong demand, but weak affordability. Investor caution, but continued competition. Those contradictions create opportunities for some and pitfalls for others. Knowing which is the key. And that's what we're going to keep unpacking as we dive deeper into the complexities of real estate in 2025. Understanding the complexities of real estate in 2025 requires shifting from the broad national picture to the subtle, often invisible forces shaping behavior at the individual level. Because as much as people pretend that housing decisions are purely financial or logical, the truth is that real estate is emotional. It always has been. And in 2025, those emotions, fear, confidence, uncertainty, anxiety, optimism, shape the market in ways that economic charts can't fully capture. One of the most significant emotional forces influencing today's buyers and sellers is something economists call anchoring. People become mentally anchored to a certain expectation, a certain price, a certain interest rate, a certain idea of what a home should cost. And when reality moves far from that anchor, it creates psychological resistance. Homeowners anchored to the low-rate era still feel like anything above 4% is expensive, even though historically it isn't. First-time buyers anchored to early 2020s prices feel like homes are forever overpriced, even if incomes, rents, or long-term value justify certain market levels. This anchoring effect explains why so many buyers feel conflicted in 2025. Prices seem too high compared to what they remember, yet they're technically justified relative to supply constraints. Rates seem too high compared to what they want, yet they're reasonable compared to historical averages. People aren't using today's reality as a baseline. They're using their memory of the world before the housing shock, and that memory creates friction. But emotions don't stop at anchoring. There's also the fear of regret, the fear of buying too soon or too late. In a market where prices rose rapidly for years, people who waited felt punished. Now, in a period of slower growth and volatility, people fear being the one left holding the bag. They wonder, should I wait for prices to drop? Then they wonder, what if they don't? It becomes a cycle of decision paralysis, and in real estate, hesitation often becomes expensive. Buyers who delay may find themselves facing higher prices or higher rents or both. Sellers who hesitate might miss windows of opportunity where demand is strong. Investors who stand still risk watching inflation quietly erode their cash while they wait for a perfect storm that may never arrive. In 2025, indecision is one of the biggest invisible costs in the market. This emotional landscape interacts with government policy in ways that amplify the uncertainty. Housing is one of the most politically sensitive topics in the country, and in the past few years, policymakers have introduced tax initiatives, zoning reforms, incentive programs, and regulatory changes that are meant to improve affordability. Some have helped, some have backfired, but all of them have created a level of unpredictability that older generations did not have to navigate.
For example, zoning reforms designed to increase density in urban areas have opened opportunities for small investors and homeowners willing to take on accessory dwelling units or duplex conversions. But these same reforms can also alter neighborhood character, increase local rental competition, or shift the balance between owner-occupied homes and investor-owned properties. Every policy comes with trade-offs, and in 2025, those trade-offs are at the forefront of buyer decision-making. Another policy area shaping the safe versus risky debate is the changing landscape of insurance. Climate-related risks, whether it's wildfires, hurricanes, flooding, or extreme weather, have made insurance premiums in some regions unpredictable and, in certain cases, prohibitively expensive. The real estate market has always considered location, but in 2025, location isn't just about convenience or lifestyle. It's about risk profiles, long-term insurability, and the potential for unexpected costs that can erase investment gains. Buyers in certain coastal or high-risk areas have started asking questions that, years ago, would have seemed paranoid. What happens if the insurer pulls out of the state? Will premiums double next year? Will resale values suffer if climate risks intensify? These concerns don't necessarily make real estate a bad investment, but they do make it more complicated. And complication itself creates perceived risk. But while these risks exist, they also come with counterbalancing forces. For every market struggling with climate concerns or insurance volatility, there are others benefiting from population inflows, economic expansion, and infrastructure upgrades. People relocating from one state to another don't just bring their belongings, they bring their demand, their incomes, and their need for housing. Regions that attract newcomers often see rising home values, stronger rental markets, and more stable long-term growth. This leads to one of the most important truths about real estate in 2025. The winners and losers of the next decade will be determined less by national trends and more by migration patterns. The U.S. is in the middle of a major demographic reshuffling. People are moving for affordability, for job opportunities, for lifestyle improvements, or for political or cultural alignment. These migration flows create powerful tailwinds in some markets and significant headwinds in others. Cities attracting young professionals and families are seeing strong demand for both rentals and home purchases. In these areas, even if interest rates stay elevated, competition remains steady because people need housing and supply can't keep up. On the other hand, regions losing population may face slower price growth or even stagnation, regardless of national trends. This is why so many analysts insist that real estate in 2025 is neither universally safe nor universally risky. It depends entirely on context. A house purchased in a declining region may struggle to appreciate, while a modest property in a high-growth area could outperform the stock market. In other words, the safety of real estate is now location-specific, not asset class-specific. But beyond demographics, another major shift is redefining what makes a property valuable: the evolution of work. Remote work isn't gone, but it's also not what it was in 2021. Hybrid models dominate, and many companies require physical presence several times a week. This halfway point has created demand for homes that balance affordability with proximity. People want to live farther from city centers than before, but not so far that commutes become unrealistic. Submarkets that strike this balance are thriving. Meanwhile, areas that were expected to boom purely because of remote work don't always hold up. Some small towns that saw explosive price growth during the pandemic have experienced moderation as people recalibrate their needs. But others have succeeded by improving infrastructure, attracting new employers, or investing in community development. It's not remote work alone driving long-term success, it's the combination of lifestyle appeal, economic opportunity, and sustainable growth. Investors, in particular, are paying close attention to these trends. Rental demand continues to grow, especially among younger adults who feel priced out of ownership or prefer flexibility. At the same time, the calculus for investors has changed. Higher mortgage rates mean cash flow is tighter, maintenance costs are rising, property taxes in some regions have increased. Regulations on landlords are expanding. This doesn't eliminate opportunity, but it requires more careful evaluation. And that raises a question many investors are asking themselves: is real estate still worth it? For some, the answer is yes, because they understand that cash flow, while important, isn't the only return on investment. Long-term appreciation, inflation resistance, tax advantages, and equity buildup still make real estate powerful. But the days of buying anything and expecting instant profit are over. 2025 rewards strategy, not speculation. For personal homeowners, the calculus is different but equally important. A home isn't just a financial asset, it's a lifestyle asset. It affects mental well-being, stability, long-term planning, and family life. Even if appreciation slows in some areas, the intrinsic value of owning a home remains strong. That's why housing demand persists even when affordability is stretched. People aren't buying just for investment potential, they're buying to build a life. But building that life is more expensive now. The gap between wages and housing costs continues to widen across many regions. Down payments take years to accumulate, maintenance costs are higher, utilities are more expensive. And that's where the risk side of the equation becomes clear. Home ownership is a commitment that requires financial resilience. People entering the market in 2025 need buffers, emergency savings, stable income, and long-term plans. Not because a crash is imminent, but because the margin for error is thinner. Still, the alternative, renting, comes with its own risks. Rent inflation hasn't disappeared. In many markets, rents increase faster than home prices. Renters face uncertainty in lease terms, potential displacement, and zero equity buildup. And with inflation still affecting everyday life, fixed mortgage payments look increasingly attractive. That's one of the biggest psychological drivers leading people toward homeownership: the desire for stability. Stability is the cornerstone of real estate's identity. And despite the turbulence, unpredictability, and affordability challenges of 2025, housing still delivers that stability better than most assets. That's why people continue to buy, even when the market looks intimidating. It's why investors stay active, even when returns are squeezed. It's why families stretch to afford homes, even when the numbers are tight. Because underneath the noise, the uncertainty, and the fear, real estate remains something deeply human. A house isn't just a financial bet, it's a place where life happens. And that intrinsic value is one of the reasons real estate, even in 2025's strange environment, retains a sense of safety that's hard to find elsewhere. Yet even with that intrinsic stability, the question still lingers. How do you make smart decisions in a market where certainty is practically extinct? To understand that, you have to look at how the foundational rules of real estate have evolved. Not disappeared, just evolved. The principles of location, scarcity, demand, and long-term value still matter, but the way they influence outcomes in 2025 is different from the way they influenced outcomes 10, 20, or 30 years ago. One of the biggest shifts shaping the market is the rise of data-driven real estate. In past decades, people relied on agents, personal judgment, and a handful of local comparables. Now, potential buyers and investors have access to vast amounts of information: rent estimates, neighborhood analytics, migration trends, risk data, and even AI-generated market forecasts. This sounds like an advantage, and in some ways it is, but it also introduces a new challenge: analysis overload. When confronted with too much information, people start second-guessing themselves. Every metric suggests a different conclusion, every forecast highlights a different risk, and every trend can be interpreted in more than one way. This information fatigue is one of the silent forces shaping 2025 behavior. People want to make rational decisions, but they're overwhelmed by conflicting data. And when people feel overwhelmed, they tend to freeze. The irony is that while more data should help buyers feel more confident, it often makes them more cautious. This contributes to a slower moving, more analytical market, one where people take longer to decide, negotiate harder, and scrutinize every aspect of a property. But data hasn't only changed buyer behavior, it has changed seller behavior too. Sellers in 2025 are more educated about market conditions than ever. They know their home's estimated value, they track nearby sales, and they follow nationwide trends. And while this knowledge empowers them, it can also make them overly ambitious. Many sellers still have price expectations rooted in the rapid appreciation of previous years. And that mismatch can lead to tense negotiations, longer listing times, and unrealistically high starting prices. Sellers don't want to feel like they are giving away equity, they would rather sit and wait. This tension between informed buyers and equally informed sellers creates a market that feels like a strategic standoff rather than a simple transaction. Each side has expectations, each side has access to analytics, each side believes they know what the home should sell for. And the result is a more complex dance, one where timing, psychology, and local economics matter more than ever. Beyond that, another shift occurring in 2025 is the changing meaning of value. Traditional valuation methods still matter, but what people consider valuable in a home is different today. For example, energy efficiency, disaster resilience, smart home features, and low maintenance costs have all become major components of perceived long-term value. These aren't just lifestyle features, they're financial ones. A home with good insulation, efficient HVAC systems, solar panels, or modern wiring can save hundreds or thousands of dollars every year. A home built with fire-resistant materials in a high-risk region may secure better insurance rates. A property in an area with stable infrastructure, reliable utilities, good internet access, strong local services tends to maintain value better. In 2025, the definition of value is expanding, and buyers who understand these new variables position themselves better for long-term success.
Yet on the flip side, the cost of maintaining a home has also changed. Labor shortages in construction and repair trades mean repair costs are higher. Material prices remain elevated. Even minor renovations can require long wait times and higher budgets. These realities add another layer of risk for buyers who stretch themselves financially just to acquire a property. A single major repair, roof replacement, HVAC failure, structural issue, can destabilize an already tight budget. This is one reason why financial resilience matters more now than it used to. A home in 2025 is not just a mortgage payment, it's a commitment to ongoing costs that may fluctuate. This leads to one of the core questions many people are grappling with. Is it smarter to buy now and accept higher carrying costs, or wait for an uncertain future where prices might drop but other expenses might rise? Because even if home prices were to fall slightly, that doesn't guarantee better overall affordability. Mortgage rates could stay elevated, insurance costs could rise, property taxes could increase, construction costs could escalate further. In other words, waiting doesn't automatically mean saving. But what does create opportunity is understanding local market dynamics at a granular level. For example, in some metro areas, new construction is finally catching up to demand, creating pockets of price relief. Developers in certain regions are offering incentives, rate buydowns, closing credits, or upgrades to attract buyers. In other regions, competition remains fierce, with bidding wars still happening for well-priced homes. The key difference is that competition in 2025 is more selective. People aren't bidding on everything anymore. They're bidding on quality. This selective competition reinforces a pattern. The gap between desirable properties and average properties is widening. Homes that are well located, well built, well maintained, and energy efficient continue to draw strong interest, even in uncertain markets. Meanwhile, homes with deferred maintenance, poor layouts, outdated systems, or location disadvantages sit longer and stagnate. This duality is shaping the risk profile of different property types. High-quality homes remain relatively safe. Lower-quality homes behave more like speculative assets.
Investors have recognized this, which is why many of them have shifted focus. Instead of chasing appreciation in fast-growing, volatile markets, many investors now prioritize cash flow in stable markets with strong rental demand. They're analyzing migration patterns, job growth, and local policy climates. They understand that real estate is no longer a universal rising tide. It's a fragmented landscape of micro-markets where each area behaves differently. This fragmentation has another consequence. Price corrections in 2025 are uneven. Some markets may see slight declines, others may plateau, and some will continue rising. This makes it difficult to use national averages as a guide. The national median home price can dip, while dozens of individual regions still see growth. Knowing this helps clarify one of the biggest misconceptions about real estate. Nationwide data is a starting point, not a conclusion. And then there's the global dimension. International investors have always played a role in U.S. real estate, but in 2025, their presence is influenced by global economic conditions. Currency fluctuations, geopolitical tensions, and international capital flows affect where and how foreign buyers choose to invest. In some cities, foreign investment has slowed, reducing competitive pressure on local buyers. In others, it remains a significant force. These global factors add another invisible layer to the safe versus risky debate. But even with all these complexities, one fundamental factor still drives real estate: long-term demand. Housing isn't like technology stocks or crypto tokens. It doesn't swing wildly on sentiment alone. It moves based on people's basic need for shelter. That need isn't going away. If anything, it's intensifying. Population growth, changing household structures, and lifestyle preferences all continue to fuel demand. Even when affordability is strained, demand persists because people can delay buying, but they can't delay needing somewhere to live. This resilience is why so many buyers still enter the market despite challenges. They're not betting on a quick return. They're securing a long-term asset. And for families, owning a home provides something beyond financial benefit: stability, control, and the ability to build a life without the uncertainty of rising rents or unexpected displacement. These intangible benefits matter deeply in a world that feels increasingly unpredictable. At the same time, the desire for stability is shaping what people look for in a property. More buyers prioritize homes with flexible spaces, home offices, additional rooms, or layouts that can adapt to changing needs. Multi-generational living is growing, creating demand for homes with extra rooms, separate entrances, or in-law suites. These trends influence property values and create new opportunities in certain areas. But the biggest thread woven through all of this is that real estate in 2025 rewards understanding. Not speculation, not gut instinct, but understanding. The people who succeed are those who study migration patterns, local economic forecasts, construction trends, insurance risk, and long-term desirability. They don't rely on broad assumptions. They evaluate specifics. They play the long game. And the long game is where the idea of safe bet or risky gamble becomes more nuanced. A home can be a safe bet if purchased with realistic expectations, strong financial planning, and an awareness of local trends. But it can become risky if purchased for the wrong reasons, at the wrong price, or in the wrong location. In 2025, knowledge is the new leverage. Understanding the landscape is what separates confident decisions from fearful ones. That understanding becomes even more important when you look closely at how financial structures in 2025 shape the way people buy, own, and evaluate real estate. Because housing isn't only about prices, it's about financing. And financing in 2025 is one of the most defining factors separating those who succeed from those who struggle. Mortgage structures have evolved, not just in terms of interest rates, but in terms of lender behavior, underwriting standards, and the types of borrowers entering the market. In the aftermath of the rapid rate hikes of previous years, lenders became more cautious, sharpening their criteria and tightening qualification guidelines. On paper, this makes the market less risky. Loans are given to stronger borrowers, reducing the chance of widespread defaults. But it also creates a barrier for many first-time buyers who find the qualification process more demanding than ever. For example, debt-to-income ratios are scrutinized with more intensity. Credit score requirements, while still flexible, are often paired with additional verification. Down payment expectations vary widely by region, but in competitive markets, larger down payments still give buyers leverage. This creates a landscape where the advantage often goes to those with more capital up front, not necessarily the most financially responsible or long-term stable individuals, but those with access to family support, accumulated savings, or equity from a prior home. This shift has contributed to an uneven playing field, and it's reshaping who gets to participate in the market. The result is a subtle generational divide. Some younger buyers feel locked out, not because they lack discipline or planning, but because the structural conditions favor established wealth. Meanwhile, older homeowners with built-up equity find themselves able to buy with cash or near-cash offers, bypassing many obstacles that younger generations face. This tension fuels one of the major psychological undercurrents of the 2025 market, the belief that unless you already own property, getting into the market is becoming nearly impossible. And while that belief isn't entirely accurate, it does affect behavior. It motivates some people to jump in aggressively before prices rise further. It discourages others from trying at all, even when they might have had a path. Perception, whether optimistic or pessimistic, creates its own reality. Meanwhile, for those who are able to enter the market, mortgage products themselves have diversified. Adjustable rate mortgages, once dismissed as too risky, have regained popularity because they provide lower initial payments. Buy-down programs where sellers or builders contribute toward temporarily lowering interest rates have become common. Some lenders offer creative hybrid products designed to soften the first few years of ownership. These tools, while helpful, also add complexity. A buyer must understand not just the price, but the long-term cost structure of their loan. Misunderstanding can turn a seemingly affordable home into a future financial strain.
This complexity introduces a kind of strategic thinking that was less common in earlier decades. Buyers in 2025 must think like portfolio managers, evaluating interest rate trajectories, inflation expectations, and liquidity buffers. They must weigh whether refinancing opportunities will emerge in the coming years or whether the initial loan terms will define the next decade. The ability to think long-term becomes a critical skill. But beyond financing, another major force shaping real estate in 2025 is technology. Not just data analytics, but the technologies integrated into the properties themselves.
Smart home systems, energy monitoring tools, security automation, and appliance connectivity aren't just luxuries anymore. They're part of the value proposition. A home with advanced tech integrations often enjoys higher buyer interest because it reduces future upgrade costs and adds convenience. However, tech integration also adds a layer of maintenance and potential obsolescence. Systems become outdated, software updates are discontinued, devices require replacements. Buyers must consider whether the home's technology is built on ecosystems that will still be supported years from now. This technological evolution is shaping how homes appreciate or stagnate. And that connects to another underappreciated factor in the safe versus risky debate: maintenance culture. In earlier decades, maintenance was straightforward: fix what's broken, upgrade when necessary. But today, homes are more complex. Systems interact, materials have shorter lifespans, environmental stresses are more intense. A home that isn't proactively maintained can deteriorate faster than one built 40 years ago. Maintenance isn't just upkeep, it's strategy. Owners who neglect it introduce long-term risk to their largest asset. At the same time, the home improvement industry faces new pressures. Labor is expensive and limited, skilled trades are in demand, material shortages still affect certain regions. These factors mean that renovation projects often take longer and cost more. In past eras, a fixer-upper was an affordable path into a desirable neighborhood. In 2025, fixer-uppers can be money traps unless buyers have the financial and logistical capacity to handle extensive renovations. This shifts the definition of opportunity. A good deal isn't just a low price, it's a property with manageable risk and predictable improvement costs. These realities lead to a larger point. Real estate in 2025 is a landscape of trade-offs: affordability versus location, flexibility versus stability, cash flow versus appreciation, simplicity versus complexity, short-term cost versus long-term value. Every buyer, whether homeowner or investor, must choose which trade-offs they're willing to accept. And that choice ultimately determines whether a property becomes a safe bet or a risky one. But beyond the practical considerations, 2025 is also a year where broader social and economic currents influence the housing market. The way people live is evolving. Household formation is shifting. More adults live with family longer, more couples delay purchasing. More workers embrace flexible living arrangements. These lifestyle patterns affect demand for different types of housing. For instance, townhomes and smaller single-family homes have surged in popularity because they offer affordability without sacrificing privacy or ownership. Newly built homes in master-planned communities attract buyers who want predictability and community amenities. Urban condos appeal to those prioritizing walkability and lower maintenance responsibilities. Meanwhile, suburban homes remain attractive for families seeking space, safety, and stability. This diversification in buyer preferences creates a mosaic of micromarkets within each city. It's no longer enough to say a city is hot or cooling. Within the same metro area, one neighborhood can be stagnating while another experiences intense demand. This hyper-local nature makes broad predictions unreliable and reinforces the importance of close, detailed evaluation. But perhaps the most important macro factor influencing real estate's risk profile in 2025 is inflation. Even with recent stabilization, inflation remains higher than the decade prior. This environment alters the relative appeal of real estate. A fixed-rate mortgage becomes a hedge against rising costs. Rents tend to rise with inflation, providing a buffer for landlords. Property values, which historically keep pace with or exceed inflation, become a protective asset. This is why many investors still consider real estate a safe long-term store of value, even when short-term conditions look challenging. But inflation can also add risk. If the cost of ownership, insurance, taxes, maintenance rises faster than wages, homeowners may feel financial strain. If inflation reduces purchasing power, demand may soften in certain markets. But over the long horizon, real estate often outperforms inflation, reinforcing its position as a foundational component of wealth building. Another macro factor is economic uncertainty. Markets in 2025 are sensitive to job growth, corporate relocations, and technological industries. Cities with diverse job markets tend to have more resilient housing sectors,
Those dependent on a single industry face volatility if that industry contracts. Understanding the economic backbone of a region becomes essential for assessing risk. And while economic uncertainty is unavoidable, people adapt. Historically, even during recessions or downturns, real estate rarely collapses nationwide. Corrections are usually regional, mild, and temporary. The worst crashes in U.S. history were tied to over-leveraging and irresponsible lending, conditions largely absent in 2025 due to stricter regulations. This is one reason many analysts argue the market is more stable than headline fears suggest, not immune to risk, but structurally stronger.
Still, structural strength doesn't eliminate emotional pressure. The cultural narrative surrounding housing is intense. People feel like they must time the market correctly, even though timing rarely determines long-term success. They fear missing out. They fear making mistakes. They fear locking themselves into a commitment before they're ready. These fears are amplified by social media, where housing content often highlights extremes, massive wins, dramatic losses, wild predictions. But the truth is quieter. Real estate rewards patience, planning, and clarity. Those who enter the market with realistic timelines, stable finances, and an understanding of local conditions tend to fare well even during uncertain periods. Those who speculate, over-leverage, or chase hype tend to face more risk. This dynamic is timeless, regardless of the year. As 2025 continues, what becomes clear is that real estate isn't polarized into safe or risky. It exists in the space between, a space where decisions matter, details matter, and strategy matters. The market may feel unpredictable, but unpredictability doesn't equal danger. It simply means that the factors shaping outcomes must be examined more carefully. The next step is understanding how individuals can navigate this uncertainty with confidence, how they can make decisions that align with their goals, their risk tolerance, and the realities of the market. And that's where the deeper insights begin to shape real-world choices. People often imagine that by the time they reach the end of their real estate journey, they'll finally get clarity. Some big revelation like a movie ending where the camera zooms out and everything suddenly makes sense. But that's not how real estate works, and in 2025, it's even less true than ever before. Real estate clarity doesn't arrive as a grand moment of certainty. It arrives as a gradual understanding that the game you're playing is different from the one you thought you signed up for. And right now, whether you rent, buy, invest, speculate, or sit on the sidelines, you're navigating a landscape shaped by forces that didn't exist even 5 years ago. So let's take everything we've covered so far. The data, the trends, the psychology, the new dynamics introduced by technology, the risks buyers underestimate, the opportunities investors overlook, and bring it all together into one cohesive answer to the question at the heart of this entire discussion. Is real estate in 2025 still a safe bet, or has it become a risky gamble? To understand that answer, you have to start by accepting one simple reality. Real estate today is not one market. It's thousands of micro-markets, each shaped by unique combinations of migration, regulation, industry, technology, zoning, supply constraints, local politics, investor behavior, climate risk, and something people underestimate, narratives. Narratives can inflate or crash markets, sometimes without any significant change in fundamentals. A city that gets labeled up and coming can suddenly see speculative buying that drives prices far beyond what local incomes can support. And a city labeled declining can lose investment well before anything actually declines. In 2025, narratives are especially powerful because information spreads at a velocity we've never seen before. One viral TikTok about a hidden gem city can push thousands of people to explore moving there. One doom post on X about commercial real estate collapse can influence market sentiment nationwide. Information is abundant, but wisdom is dwindling. And that disconnect is a major reason why real estate looks both safe and risky at the same time. To understand whether housing is a safe bet, you have to look at timeframes. Over long periods, 20, 30, 40 years, real estate has historically outperformed inflation, produced increasing rents, and provided tax advantages that other assets simply can't match. But the challenge is that most people don't think in 30-year timeframes. They think in 3-year timeframes. And when you shrink the lens to short periods, real estate behaves completely differently. It stops being a slow-moving, stable asset and becomes a volatile, sentiment-driven, leveraged amplified investment where timing suddenly matters a lot more. Someone buying in 2021 at a 2.75% mortgage rate looks like a genius in 2025. Someone buying in 2022 at the peak of price acceleration with a 6.5% rate might feel stuck. Same asset class, very different outcomes. That's why answering the safe or risky question requires honesty. Real estate is both, depending on how you approach it. Let's dig deeper. One of the biggest reasons people still consider real estate safe is that it's tangible. It's a physical asset you can see and touch. You can live in it, rent it out, improve it, refinance it. Stocks don't let you add a bedroom to increase dividends. Bonds don't let you repaint the exterior to boost yield. Tangibility gives people a sense of security. But in 2025, tangibility doesn't protect you from macroeconomic forces. It doesn't shield you from interest rate volatility. It doesn't guarantee stable rent growth. It doesn't stop insurance costs from rising or natural disasters from impacting a region's desirability. A house might be solid, but the financial system around it is not nearly as solid as many people assume. This is where risk comes in, not from the house, but from the ecosystem that determines what that house is worth. Interest rates, for example, have become the single most powerful force shaping home affordability. And because rates don't just affect monthly payments, they affect investor demand, new construction, refinancing ability, and institutional buying. They influence nearly every aspect of housing. In 2025, the housing market is still being held up by inventory shortages, locked-in low-rate owners refusing to move, and demographic demand from millennials hitting peak household formation years. But these are not permanent conditions. They're temporary distortions created by past policy decisions. So if someone buys a house today assuming that low inventory will last forever, they're making a risky bet. If someone buys a house assuming that high rates will stay high indefinitely, they're also making a risky bet. The truth lies somewhere between extremes. The housing market is temporarily elevated by artificial constraints, and those constraints can shift quickly when mortgage rates, zoning reform, new construction incentives, or demographic trends shift.
Let's talk about another dimension of risk, affordability. The ratio of home prices to incomes in many U.S. markets is at levels that historically precede corrections, not crashes, corrections. Declines of 5 to 15% in overheated markets are entirely possible, especially if sellers begin capitulating or if rates drop just enough to encourage move-up buyers to list their homes, increasing inventory faster than demand can absorb it. But here's where the safe side of the equation comes back in. Even if prices correct in the short term, demand for shelter doesn't disappear. People don't stop needing homes. And because the U.S. has underbuilt millions of units over the last decade, long-term upward pressure on prices is still very real. This is why long-term investors often succeed even when short-term buyers struggle. Housing becomes extremely risky when people treat it like a short-term trade. Another factor shaping the 2025 market is the rise of institutional investors. While they don't own a majority of homes, their presence influences pricing psychology. When institutions buy aggressively, retail buyers panic and overbid. When institutions pause, retail buyers interpret it as a warning sign. The behavior of big investors affects markets even when they're not actively buying. But institutions are not immune to economic pressures. They have acquisition models based on cap rates, rent growth projections, and borrowing costs. If those numbers stop making sense, they step back or sell. And in markets where institutions hold large blocks of inventory, any sudden shift in strategy can ripple across neighborhoods. Technology introduces yet another layer. AI-driven appraisal tools, automated underwriting, algorithmic pricing models, and platform-based real estate transactions have changed how buyers search, compare, and compete. When buyers are armed with more data, markets become more efficient, but also more reactive. Small trends spread faster, small fears grow stronger, and small hype cycles get amplified. Then there's remote work, a wild card that continues to reshape housing patterns in real time. Some cities that boomed in 2021 saw reversals. Others found stability.
Some areas that lost population have regained it. Remote work is no longer a temporary pandemic phenomenon. It's a structural shift that permanently changed where people choose to live. But as companies tighten policies or adopt hybrid models, migration patterns shift again. And when migration shifts, so do home prices. Let's address something many buyers overlook: climate risk. If interest rates are the biggest financial risk to housing, climate risk is the biggest physical and insurance-related risk. Some areas are seeing insurance premiums double or triple. Some insurers are pulling out entirely. When insurance becomes unstable, values can fall, not because demand is low, but because financing becomes harder. A house without affordable insurance is a ticking bomb for its value. Then there's the generational aspect. Millennials are buying later than previous generations. Gen Z is entering the market facing even tougher affordability conditions. Boomers are holding onto homes longer. This generational imbalance affects turnover, inventory, and pricing. So where does all of this lead us? Here's the honest answer. Real estate in 2025 is not universally safe, and it is not universally risky. It is conditional. It depends on how long you hold, where you buy, what your financial stability looks like, how you manage leverage, what market dynamics shape your region, and how well you understand the difference between real value and speculative hype. If you buy a fundamentally strong property in a stable or growing region with a long-term mindset, conservative financing, and a focus on cash flow or sustainable affordability, real estate is still one of the safest investments you can make. But if you buy based on fear of missing out, stretch your finances to the limit, depend entirely on future price appreciation, or assume the next few years will be smooth and predictable, then yes, real estate becomes a risky gamble. The truth is simple. Real estate itself isn't risky. People's assumptions are. The safest investors aren't the ones who buy the most property. They're the ones who understand their local markets deeply, evaluate their risk tolerance honestly, stay patient when others panic, and avoid the temptation to force a deal when the numbers don't make sense. And if you've made it this far into this video, you already know more about the real estate landscape of 2025 than most buyers, renters, or even agents. Knowledge doesn't eliminate risk, but it gives you the power to navigate it. Housing in 2025 isn't a guaranteed win, nor is it a guaranteed loss. It's a complex puzzle, one where the people who take time to understand the pieces will always outperform those who don't. And no matter what decision you make, buying, waiting, renting, investing, downsizing, or relocating, what matters most is that the decision aligns with your financial reality, your long-term goals, and your tolerance for uncertainty. Real estate isn't about timing the market. It's about knowing why you're entering the market in the first place. This entire video is for educational purposes only, not financial advice. Always do your own research before making any real estate or financial decision. And with that, thank you for watching. Your attention means more than you know.